Joining us now to share his commentary on the day's market performance is Burgess from Nedbank Private Wealth. Thank you so much for your time, Carl. It's been quite an interesting week, and actually seeming that largely the JSE has been unbothered. I think we only saw a pullback yesterday, and it is back now trading in green territory. What have you made of what has driven the markets this week?
Yeah, so I think quite a lot of caution at the moment. I think, if you look at the performance over the last 7 days, last 5 days, in fact, we're probably only up about 2%. Somewhere between 1.5% and 2%, and really all eyes are on geopolitics, and specifically the Trump-Putin meeting in Alaska this weekend and what may come of that. If you look on the economic data front, though, we've got quite a few numbers coming out of the US, which I think will point investors in the right direction in terms of where inflation is heading in the US. Obviously, big implications for the White House or the Trump administration and its sort of ongoing niggle with the Fed.
Yeah.
So quite a lot to look forward to there. But perhaps not a huge focus on SA at the moment. Also been a fairly quiet time in terms of corporate results.
Well, I mean, let's get into the Chinese economy, because actually economic data there, I think lately has been surprising to the upside. But we actually had a disappointment coming through today with China seeming to experience a slowdown in July. We had the metrics, retail sales, industrial output, fixed asset investment, all surprising to the downside. What do you make of this kind of halt in momentum that we've seen there?
Yeah, look, I think the Chinese economy's been coming under a bit of pressure for some time. I mean, they've set themselves a goal of growing at 5% or GDP growth of 5%. So which in the context of China is obviously fairly low, particularly over the last 30 years. But if you have a look at sort of factory output, that's come in at 5.7%, which is probably the lowest that we've seen in the last 12 months. And then we've seen retail sales also coming in at, I think, 3.7%, which is, again, the lowest that we've seen since December last year. So perhaps tariffs and the ongoing uncertainty in the global economy really biting that economy at the moment. But, we've also seen, extreme weather conditions in China that's impacting their growth, particularly on the agri sector. If you look at their sort of, the incredible temperatures that we've seen them experiencing in Shanghai and Beijing, sort of north of 40 degrees, which have, been at record highs.
Yeah. And
considering that, China feeds around about 20% of the global population, and, this is really off the back of 6% of the fresh water supplies of the world and about 9% of the arable land. So obviously climate change and significant weather impacts play a big role in that economy. But again, you've still got the property sector coming under pressure.
Yeah.
So a lot to unpack in the Chinese market there, or the Chinese economy, and certainly they play a massive role in the global context.
Yeah, indeed, it's quite sobering to assess some of these headwinds, particularly their impact in terms of some of the metrics where you've seen, low growth that hasn't been seen, or numbers that we haven't seen since 2020.
Yeah.
And of course, we know how difficult that period was. Well, let's get into the company news that came out of the JSE. We did get an update both from Remgro and Vodacom concerning Vodacom's acquisition, 30% acquisition of Maziv. Of course, that's been going on for years. There was an appeal hearing late last month, and they've told us that the Competition Appeal Court has actually approved that transaction. Is it all systems go?
Well, no, not quite. We still need to wait for the unconditional approval from the Competition Commission, as far as I understand it. So we'll perhaps leave that until that sort of officially gets the green light, and then I guess we can unpack it at that point.
Yeah, and I see. I was looking at the share prices. Vodacom not really moving much. I think it was down at 0.2% at some point, and I think Remgro is up more than 1%. Yeah. So really, not much reaction from investors.
No.
Yeah, of course. It has been going on for a while. So considering the fact that we are still waiting for more approvals, we'll keep our hats on. Let's get into banking. Nedbank. Well, actually, I mean, you're from Nedbank Private Wealth, so let's get into.
So probably not the best person. To comment on this, but I think as sort of our CEO Jason Quinn mentioned, this is obviously part of a sort of a strategic refocus on SADC and the sort of the disposal of ETI. So that's probably sort of the best I could do comments wise on that, just given my my current position, and there's certain people that are better positioned than I am to comment on that particular disposal.
Awesome. Well, I'm sure we'll unpack that on Stockwatch shortly. Let's get into Stadio that released their interim trading statement today. So the tertiary private education provider saying that it expects its core HEPS to climb by as much as 32.7%. No detail there at all. Care to fill in the colours for us?
Yeah, so look, I think you've seen strong demand from most of these whether it's higher or secondary education businesses like Advertech and Stadio. So look, this is a trading statement, so really not much information. It just gives us some trend lines as far as what we can expect from their results. So, but again, if you're looking at EPS growth of somewhere between 20 and 30%, that's certainly positive. And they've got some strong brands, Mill Park as an example, Avda. So really strong brands in the higher, sort of higher education space. So yeah, we'll see what those results have for us at the end of the month when they release them. But certainly positive development from them.
All right, and indeed we have seen investors trading on those positive numbers with the share up almost 2% currently. But Carl, before we get to your stock pick, let's take a moment to touch on what your peers are finding favorable.
So everyone will be familiar with Pepkor. They own the Pep brand. That's about 3,000 stores in South Africa and about 1,000 Ackerman stores. They own a business in South America called Avenido. They are growing both their revenue line and their profitability line. And that is impressive to investors in an environment where your economy is only growing maybe, let's call it 2-3%. Well, at the lower end of that. On top of that, as I've said before a few times on this program, show me the incentive and I will show you the behavior. Now, the Chief Executive Officer of Pepkor, Peter Erasmus, personally bought 1.6 billion of shares the other day. And so he's showing his belief in the company. So in some sense, I like the model, I like the management, but if he's prepared to put his money there, then so am I.
Astral. So I saw the Rainbow results recently, and they confirmed a few things for me. I think the chicken industry is very cyclical, and at the worst of times, it's horrible, and you've seen how earnings go backwards. Yeah. But we're sitting in the sun right now. IQF prices are rising, volumes are rising, and raw material costs are falling. Astral's got excess capacity, and they've probably been able to sell more chicken through that excess capacity, and their margins must be widening. They're a well-managed business. They no longer have to deal with load shedding or avian flu or any of the negatives that we've seen in the recent past. So I think this year and next year, you should see earnings coming back to all-time highs, and the ability to return capital to investors definitely exists, whether through share buybacks or special dividends. So I think for where it's trading right now, there's quite a bit more upside for that stock.
Well, Carl, let's take a look at Pepkor. And I mean, Shane is picking Pepkor in a time when apparel retailers like TFG and Truworths have actually seen a lot of pain in their South African businesses and in their share prices. But seeming that Shane seems to think that Pepkor is a standout. Your take?
Yeah, so look, I can't fault his investment thesis around that. I think if you look at their footprint through Ackermans and Pep, I mentioned 4,000 stores and 1,000 stores respectively. Really strong brands, well positioned in the SA economy. I think if you look at it from a valuation perspective, probably trading at a significantly higher multiple than the likes of TFG or Truworths. So in fact, we don't have exposure to Pepkor in our client model portfolios, but we do have exposure to the Pashini Group. So I think if you look across apparel retail, probably some very attractive valuations coming through there, particularly at a time when you are seeing sentiment in SA perhaps starting to pick up. We obviously need some growth to drive that. But yeah, certainly can't fault that stock pick.
All right. Let's get into chicken. And of course, we know the difficulties that industry has gone through. But seeming that there's a turnaround there, Roy chose Astral on the back of numbers that we've seen coming out of Rainbow Chicken. Would this maybe be the right time to get into this kind of stock, even though we do have that kind of embedded cyclicality and volatility?
Yeah, so Astral's an interesting business. I think if you look at the two main drivers of that business, it's really consumer sentiment and whether they've got some excess cash flow. So obviously, provide chicken to the market, and this along with pork is probably the two most attractively priced proteins in the market. So you've got consumer sentiment playing a big role in whether consumers are buying that protein, and then secondly, you've got maize prices. So that obviously has a big impact on the business and drives around 30 or 40% of their costs. So a fairly punchy number. We've seen, fairly good crops or fairly good maize production in South Africa. That bodes well for the business because it brings their costs lower. There is some positive sentiment around SA, certainly around the consumer, and that does bode well. At 186 Rand a share or thereabouts, I don't know if I'd be a buyer of Astral, but if you look at the valuation, 6.5 times earnings, it's really not very demanding. But if consumer sentiment turns, if the maize crop in South Africa is not as good as expected, there could be some headwinds for that. So I think pricing probably just running a bit ahead of itself there. But again, I think it's a very interesting business. It's not a business that we have exposure to, particularly for our clients. But yeah, again, at 6.5 times earnings, I think you've got a lot of room for error there. The one thing that I would say is that when you are basing an investment thesis on some form of re-rating, so investors paying 6.5, or that they have been paying 6.5, investors paying 9 times earnings perhaps for this business, it does introduce quite a lot of risk, I think, to your investment case, as opposed to purely looking at your return sources of earnings and dividends. So I think a lot to unpack there. There's certainly two very interesting stock picks.
Okay, well, let's get into your stock pick. What counter are you finding opportunity in today, Carl?
So we're finding quite a lot of opportunity in SPAR at the moment, and perhaps just a bit of background on this. I think if we cast our minds back about 2 years, SPAR came under quite a lot of pressure. We were holders of SPAR Group for our clients at that point in time. There was issues around favoritism with franchisees, really quite a few red flags from a C-suite level that we didn't like. We took the view that we didn't really want to participate in that, even though we felt that the underlying operations were strong. There were also other issues. Poland was unprofitable. There was, uncertainty in the investor community around whether that would be profitable or not. They've gone on to sell that business. They've gone on to have a change in management over the last 2 years. They've bedded down their SAP issue. And I think, in investments, when the facts change, I think you need to change your mind. And that's probably a very good example of what we've done here. Again, we think that there's value in this business at somewhere between 9 and 11 times earnings. I think that there's a lot of opportunity there. And again, they've sold down their Polish business, really focusing on their core SA business, which we feel is strong. So, at a time when, the all-share index is trading above 100,000 points, not particularly looking cheap, I think your stock selection needs to be very, very shrewd. And I think, we're finding opportunity in businesses like SPAR.
Very interesting. Thank you so much for your time and for your analysis today. Carl, really appreciate it. That was Carl Burgess from Nedbank Private Wealth.